Welcome to The Explainer. Today, we're going to break down a really fascinating strategy for turning your investment portfolio into a straight-up cash flow engine. And we're basing this on some great analysis of the tools we have available right now.
So let's just start with this powerful idea. What if you could shift your focus away from just growing some abstract number to actually making your wealth work for you, providing a real tangible income month after month?
Okay, so here's our roadmap for today. We're going to start with the big idea, the philosophy behind it. Then we'll look at the engine that actually drives the income. After that, we'll dive into a practical blueprint. And finally, we'll get into the really crucial stuff, the trade-offs and the reality checks.
First up, let's talk about the core philosophy of investing for cash flow. You know, for a lot of people, this is a huge shift from the traditional way we've been taught to think about retirement. For decades, everyone relied on the 4% rule, right? You sell off little pieces of your nest egg every year and just hope it lasts. But that strategy is getting tougher and tougher. So what's the alternative? What if you could live off the income your portfolio generates without touching the original principle? Well, that is the game changer we're looking at today. So, what's the engine that powers all this cash flow? Well, it's a specific type of investment tool that's become incredibly popular lately: covered call ETFs.
Okay, in simple terms, these funds own the exact same stocks you already know, like the big ones in the S&P 500. But then they do something pretty clever. They essentially rent out a little bit of the stock's future growth potential, and in exchange for that, they get paid immediate cash. That cash is called a premium.
And the whole process really breaks down into 4 simple, repeatable steps. The fund owns the stocks, it sells the options, it collects all that cash from the premiums, and then it pays it directly out to you. It's just a continuous cycle designed for one thing and one thing only: generating income.
All right, so now that we get the engine, let's look at an actual blueprint for putting together a portfolio that's specifically designed to generate this kind of high-yield income. So the goal of the strategy we're exploring here is to build a portfolio that's targeting an annual yield somewhere in this range. I mean, let's be honest, a double-digit yield is a really serious number for any income investor. So how do you get there? Well, a diversified approach might involve blending a few different types of these covered call ETFs. This example portfolio, for instance, combines funds that track the S&P 500 with ones that track the tech-heavy NASDAQ 100. Each has a different yield, but together they create a really powerful blended average.
And you can see right here how much this strategy emphasizes diversification. You are not putting all your eggs in one basket. Instead, you're spreading that allocation equally across 4 different funds, which helps link your income stream to the stability of the entire market.
Okay, this all sounds pretty amazing, right? So why isn't everybody doing this? Why would you choose this over, say, just a simple S&P 500 index fund? Well, let's put them side by side.
Here's the crucial point. You're making a deliberate choice. You are choosing to prioritize a consistent, predictable paycheck from your portfolio, but, and this is the big but, in exchange, you're accepting that your total long-term growth is probably going to be lower than a pure growth strategy, because your upside is capped by those options you're selling.
This quote just perfectly gets to the heart of the whole philosophical difference, doesn't it? The accumulation phase of your life is all about building wealth. This income strategy, it's about turning that wealth you've built into freedom, into cash flow that you can actually use today. All right, let's get real for a minute. No investment strategy is a free lunch, so it's absolutely essential to understand the potential downsides and the risks before you even think about going down this path.
These are the key trade-offs, plain and simple. You are going to sacrifice some growth potential when the market is booming. Those high payouts can also eat into the fund's underlying value if the returns don't keep up. So this isn't a set-it-and-forget-it strategy in the same way an index fund is.
Now, there's a key feature of a lot of these ETFs we need to talk about, and it's called return of capital. It's really important for their tax efficiency. It's a bit unique because it's not taxed like a normal dividend in the year you get it. Here's how it works.
So, on the one hand, return of capital is fantastic for taxes, right? You get to defer them. But it's also the exact mechanism behind that NAV erosion risk we just mentioned. Think of it this way. It's like buying a rental property for $100 grand. If it pays you $5,000 in cash flow, but the property's value also drops by $5,000, you haven't really made a profit, have you? That's what can happen here. They are literally 2 sides of the same coin.
Ultimately, this strategy isn't about getting rich quick, and it's definitely not about trying to beat the market every single year or chasing the highest possible return.
It's really a fundamental shift in thinking about what you want your investments to do for you, Not just in 30 years, but right now, today. And that's a question that every single investor has to answer for themselves.